So good evening all, and welcome to this interesting panel discussion on investing in India's Amrit Kaal. And we are not restricting ourselves to equities, but want to know much more than equities. Where are the areas which can be encashed by the members who are participating in today's discussion? And watching live, maybe we are few over here, but there are many who would be expecting some good insights on the investing opportunities which are unfolding because of the India's development. And when I'm looking at India's development, recent two events can be just looked at from how it is progressing towards Amrit Kaal. One has been the Chandrayaan-3. Obviously, it is the most proud moment which India is witnessing during these recent times. And it has become a force to reckon, not only in India, but in the space now. So it has become fourth country to be there in the space. And the second one is the just concluded BRICS event, where India has played a pivotal role in including more than additional 6 countries. And the main advantage which we can see is that there are 3 major oil producing countries which are now part of this BRICS conglomerate. And that may have some bearing on our, what you can say, managing the balance of payment going forward. Maybe that's what I expect from this development, because now 50% of the population is covered through this BRICS network, and more than, I think, 1/3 of the GDP is also 2/3 of the GDP is from these countries which are part of the BRICS network. Now, not taking much of the time, I would start with the panel discussion. And here I will request each of the panelists, because at present 2 are there. I will request Vikas later on, but at least you can spare 5 to 7 minutes of yours on the prospects in India vis-a-vis the asset classes which are worth investing in the next decade. So each one's perspective will give more insight into the way in the investing can be taken forward. So I will ask Aditya to first give his thoughts on the same.
Sure. Thanks a lot. Thanks for having me as a panelist. So essentially, more or less, I've been an equity guy throughout my career. But, when I started this equity journey in 1999, typical behavior of most of us who get introduced to equity as an asset class as a starting point is to enter the party late, and then we get slapped hard. And this is what happened to me. I started with some beginner's luck. I made 50% return in three months. Basically, I thought this is a best profession in the world. Possibly leave your studies and just jump into equity. The party is going on. But obviously NASDAQ crashed. I lost a lot of money, and this is a typical behavior of a first-time investor. So I think the seeds of success are sown by seeing failure first. I'm a self-trained investor. But one thing that I have witnessed, and I've specialized into small and mid-cap investing for the last 20 years, and this is what I do for a living. One of the things that I have witnessed is that the last decade and I've been, I've invested into India, worked for a few of foreign institutional investors based out of London. I think the most important factor that, a lot of us don't recognize is that today, the last decade belonged to developed markets, right? If you look at dollar returns in terms of, equities across the globe, one of the things that you'll notice today is that, and it is a very, very important moment in India's equity market history. Why do I say that? Because last 10 years, broadly, the Nifty has given, 250% return, thereabouts, 248 to be very precise, June ending data. Roughly, we have broadly, lost 100% in rupee dollar, moving from 40 to 80, 82, thereabouts. So the dollar return is 148%. The best performing index in the world over the last decade has been NASDAQ, 300% return, because obviously it is a dollar denominated index. Our returns are just a shade below, the other 2 indices, which is S&P and Dow. But one thing that we have to understand here is that, India is the best performing emerging market after Taiwan on a dollar term basis over the last 10 years. I meet a lot of NRI investors who, migrated to, let's say, Africa, have not been investing into India, have a tendency of doing global asset allocation because they don't believe in potential of India, possibly. They have invested into places like China, and last 13 years, we all know what has happened to, larger emerging markets like China. So the first point is that, within the emerging market pack, India has been the best performing emerging market after Taiwan. Taiwan is more like 113% return. Most of the BRIC countries have been negative in terms of local currency terms, right? So this is point number one to remember. Point number two, which is a very, very pertinent point, is that if you look at 3-year data, it'll look starkly different, basically. Mexico is the best performing emerging market over a 3-year period. The returns have been 87%. India is at number 2 within the emerging market pack. Our returns are more or less like 70% in dollar terms. Our returns are 2x of the US indices over a 3-year period, right? Fortunately for us, this has also coincided with a lot of FII selling, which has gone into the market. So my view is that, this is going to reverse going forward, because typically in every election year, you get money in the market. Just taking from Abhay's point, I think so a very important point that comes to my mind, when we look at, India as a part of global emerging markets, is that what happens to dollar returns, as we move forward, essentially. Right. And a very simple point here is that if you look at, dollar returns, we are entering into an area of possibly a stability, or that devaluation that we saw over the last 10 years versus vis-a-vis the rupee dollar. I think so it is a known and a very well understood fact that we have possibly devalued. Rupee has devalued against the dollar over a 3, 5, 10, 20-year period, broadly at 4% CAGR. But I think so last year, something very interesting happened wherein crude was at $100. Obviously, the yen, the GBP, the euro was under pressure, and the rupee was under pressure, but not the emerging market currencies did well. What it also means is that, we have learned from our failures, because we had been hit hard. Most of the emerging markets have learned their lessons in the sense that, some central bank policy needs to be, counter-cyclical in nature, and this is what we have seen. And the most important part of our equation, is software export to oil import. When we had a currency crisis in 2011 in India, then that is the time when Raghuram Rajan stepped in. We had this NRI scheme, basically $40 billion of shortfall, leveraging of deposits. Our belief is that, we are just going to balance that equation in terms of $100. And now the good news is that $100 oil is possibly equivalent to 90-80 because we are sourcing more from Russia, basically, essentially. So my view is that, we are getting into an environment wherein flows can be very steady. Currency could be stable. I'm not making a case of, rupee appreciating vis-a-vis the dollar. Dollar is the king. It continues to be the reserve currency. So I think so that is going to be an important factor. Structurally, I think so the story is very well understood. The only fact of the matter is that, it has taken us 11 years in terms of, GDP per capita to move from $1,100 to $2,200. That is when Morgan Stanley made that estimate in 2011. Possibly it was not known that it will take us 11 years. All I know is that, it is going to take us less than 11 years, So the pace of growth in terms of doubling from here on, again, is going to be possibly lesser than 11 years. What it means is that, opportunities are plenty in terms of, equities at least. And obviously, last decade was also marred by a lot of disruption that happened. If you look at what happened in India, and if you step back and think about it, 2014, we had a regime change in government. I think so for 4 or 5 years, we had demonetization, GST reform, then we had COVID, so on and so forth. What it has also enabled the government to do is to act really as an enabler. Because if you look at, the taxation, or you look at, rates generally in India, who would have imagined that I as a borrower can borrow at 6.5%, in terms of mortgages. This is what happened essentially. So my view is that, it immensely helps a lot of businesses. Obviously, if the cost of capital declines, the spread between return on capital and cost of capital goes up. It is as simple as that. So that is the real potential in my view in terms of, these are some points I wanted to point out.
Thank you, Aditya. Welcome, Vikas. But I will first go with a view from, no, I wanted a contrary view also, because you will give me some insights on the commodities and take it to the level of how to invest in equities. So would like to have your initial remarks on the way forward.
Though the topic is Amrit Kaal, all right, I would not consider that our economy started with 1947. I would rather consider it started in 1991 with the dire straits we were in. And whatever the dream team at that time brought us out of all the crisis and everything, that brings me to the point that in 2023, India is just 32 years old. And we are in a phase which is kind of a cost push inflation. And that is what is connecting all asset classes into one just now. The growth, the spending, and if the policies are right, I think we are at the cusp of a parabolic run. Just wishfully, nothing gets derailed in that part of it. And if that is what is the case for the next coming couple of years, because usually cost push inflation results in a secular bull run in all 7 asset classes, which are demarcated independently also. The proportion of their rise may be slightly different, but yes, all would be rising in one go. And usually this is followed by a phase of hyperinflation. That is how the economic cycles go. Even if India comes out with all kinds of policies to control that part of inflation, it will not be able to control, because the vagaries of weather are upon each and every country of the world today. And India is also not going to escape that part of it. So it will be rather beneficial that we maintain a continuous growth policy rather than talking about inflation every now and then. Because if growth continues, and even if inflation is in early double digits, India as a country with its populace can manage the show and still maintain amongst the top 5 sweet spots of investments. That is what I would start with.
Okay, thank you. Because we have just started, and initially we would like to have a 5 to 7 minutes spent on your viewpoint on the investing avenues and the event and what you can say investing growth opportunities which are unfolding in India.
Sure. Thank you very much, and my apologies for getting delayed. I think my view would not be very different. I always say, that we are in one of the best phase of India growth story. I see very much similar to where US was in 80s. In case of, like, if you see any economy which goes from $2 to $5 trillion kind of curve, goes to a very sizable wealth creation opportunity at the economy level. And fortunately for us, what has happened in last 10 years or 9 years, post 2014 specifically, a lot of deep-rooted reforms were carried out. When they were carried out, they actually created problems for all of us at different level, because they were deep-rooted and painful reforms. But after all those things have been, foundation has been laid, I think today India stands very solid on those pillars foundation for a sustainable decade of growth or maybe more. And fortunately, we have a leadership which is, and a lot of enabling factor which never existed, whether it is in form of technology, whether it is in form of enabling laws, whether it is in form of new, and in fact, I say that pandemic has been a boon for India, economically speaking. Of course, humanity-wise, we all suffered, but the manufacturing focus, which was not there before. In India, it has actually disproportionately grown up. So today, if you see, our banking sector, which always was a very weak point for Indian economy, whenever we had a problem, it was our weak point, right? Post IBC, and so if you see, we had 3 or 4 capital cycles of NPAs. One was retail cycle of 2007-8. Then we did not have our CIBIL infrastructure ready and operating. We had 2 corporate credit cycle, early 2000, 2009 to 14. That time we did not have IBC infrastructure. So now both of them are working, and today, most people or any borrower would not want to default. Of course, cycle-wise challenges will happen, and our banking sector is lot supported by the data, so technology infrastructure. And today your credit assessments are done very differently, right? So banking sector is in shape best ever. Our manufacturing sector is growing, and again, being supported by government and China +1. Our infrastructure spend is massively sort of growing. I don't think today we can all road, railways, ports, airports. There's no, it is visible in front of us, the amount of spend which is happening. IT sector is growing. IT sector in last 5 years has hired more people than last 3 years has hired more people than they have hired more in last 10 years. That sector is expected to grow at 10-12% growth, and implication of that is on the employment generation in India, right? Real estate sector, which was in doldrums for all many years, is again started to sort of firing. So I will say that in my 25 years of career, I haven't seen so many sectors, so many triggers of growth coming together and aligning in the same space. And all these things will lead to sustainable growth. When these things happen together, sum total is not equal to, it is much more than the sum total. It's because that amplifying effect is far more higher. And then so it's that flywheel has started moving, and then it gains its own momentum. And fortunately today, India is one of the few economy which has all pillars of growth: consumption, investments, going side by side, and exports. We are very balanced in terms of services, and now manufacturing is kicking in. So, we are if you see, China is largely export driven. Brazil is largely, commodity focused. So we are very balanced in many counts. And lastly, I would say we all believe to grow that Indian rupee depreciates by 5-7% every year, right? This is in our psyche. But I think that part also has changed, according to me. Gone are those days. See, our biggest problem historically has been our current account deficit. Whenever Indian currency, Indian interest rates get impacted, it is because of current account deficit. 2014, we became part of Fragile 5 because our current account deficit became 4%, right? And same way in 90s. So wherever current account deficit becomes a very big problem, we all start sort of, the currency has an impact, right? Our current account deficit is about $80 to $100 billion, right? With now it is about 2% of GDP. Earlier it was 4% GDP in 2014. If you just see the delta which is coming, only because of 2 sectors, in IT in next 5 years will grow from $190 billion to almost $350 to $400 billion. So IT alone will add $200 billion of FX. Manufacturing, which is again in next 5-6 years, is supposed to add another less import, more export, add about $100 to $150 billion of delta on that. So if you see $200-300 billion of delta is coming on the current account deficit only because of these 2 things. It means that we will become current account surplus country. And whenever a country's current account becomes surplus, it's a very big change happens in the lives of that country. Only 4 countries in the last 40 years have gone through the journey: Korea, Japan, Taiwan, China. And they have had massive run once that turn happens. So I think India is staring, and as we get into this Amrit Kaal, we will, shed this problem of ours of being current account deficit to current account surplus. We will go towards 6,500 crore of per capita income. So all those things, will fire. And that and fortunately we don't appreciate this. We have a democratic setup, which is very, very essential. By the way, China, despite their GDP growth, has created no returns in their capital markets. If you just see last 15 years, they have delivered less than single-digit returns in their equity despite economic growth. Why? Because that's a very different setup. So India is democratic setup. We actually, when we live here, we undervalue that. So that's
Yeah.
so we have a very good democratic setup. We have a demography which is working for us. China is aging, India is young. So I think if you see, I say all stars are aligned right now for India. Only thing we have to hope that government continues.
Yeah.
So so all vote for.
Correct. Thanks, all the panelists for your frank introductory remarks, and from the way you have described the progress which may happen, I think we should be looking at that India will not remain as an emerging economy, but a developed economy, and we should be out of that emerging economy setup. Going forward, we may be leading the way the decisions will be taken at the world level. And now we will delve more into the specific investments also going forward. So initially, what I would like to know is that many a times what happens that there is low returns in various asset classes. Now, if that low returns are there, investors are normally lured to invest in high risk assets or other alternate investments. So what is the view and what is the way you think the approach should be when the low yields are there in the markets? What should be the approach of the investor to invest in, and what category or asset class they should invest? Because you can start.
So first of all, I think one has to understand each asset class has a broad range of return. And those are the expectations of return should be. Anybody trying to shoot for anything extra that return, then it will obviously invite for trouble. So very often, so you have to design your portfolio based on, so let's say if it's a fixed income, return, typically you won't get more than, depending on what kind of risk you are supposed to take within the fixed income, between, government GSEC plus 400 basis point, right? So 7 to 10, 11% kind of return. If you try to shoot anything above that, then you are taking different risk, and then you have to live with that. So every asset class you will see equities, according to me, in next 8, 10 years, 15 years, India has delivered, by the way, in last 20 years, 18% CAGR return, right? And I see no reason why it cannot, we don't realize this. 18% CAGR return equities have delivered in last 20 years. So in 2003, it was 800, 900 points of Nifty. Today, we are almost 20 times, right? So same thing, in my opinion, I see no reason why it will continue. Not happen again next 10, again, if you look at long term. Then there are, I don't understand much of gold, to be very frank. Historically, gold has delivered return because of the currency, not as an asset class because of the gold. India maybe think that gold has delivered return. Actually, it's not gold, it's a dollar which has delivered the return. So, and real estate, again, I feel real estate and equities are the only two asset classes which probably beat inflation with a beat inflation, but equity beat by mile, real estate kind of little bit above. And I personally feel that real estate, what happened historically may not happen going forward because there were a lot of reasons. I think, again, in real estate, asset class returns are driven also by the policies of the government, because, at least in real estate, how much supply you open also determines. It's like in many cities, you will see there's a ring road, then there's outer ring road. So if you keep on opening the infrastructure, real estate prices will remain controlled. But if you don't open the infrastructure, real estate will keep on going up. Like Bombay is a classic case where we don't have shortage of land, but we did not have a supportive policy, and hence prices went up. But if you go to cities like Ahmedabad and all, despite city growing at 10% plus GDP for 20 years, real estate prices have hardly grown. The 5-6% kind of rate, right? Again, because the government supportive in terms of opening up the infrastructure.
But don't you think that if the real estate prices are not going up, it will not be worthwhile to invest in such cities?
No, that's what I'm saying. So you have to understand that. But see, real estate will go 5-6% is whatever the inflation plus. But, one should not expect, in my opinion, so inflation plus return, if inflation 8-10%, it will give you that kind of return. So inflation plus return, it will give. So, I mean, again, I may be biased person, but from a if you have a long-term perspective, I don't find any asset class very other than equity as a, that's the only asset class where you buy your stock, it's in your demat, you pay, no title issue, no nothing, easiest to deal with, easiest to operate with, so, but you have to understanding and you have to very long horizon. But one should have a balanced allocation, and fixed income also. There are very, very interesting sort of opportunities coming up, especially the bond is a very decent opportunity. Bond market is just opening up. It can also give, 300-400 basis point above the risk-free rate, which is what one should try. Newer and newer asset classes are opening up, like distress is opening up, structured finance is opening up, but they are very, one has to understand. It will be wrong to invest without understanding them very often. And that is where the, what you call, cheating happens, because sales people will come and, sell different kind of high return expectation product. And then that's where most people get trapped. I mean, we have seen people, from Bombay city, 1,200 crore rupees was given in options trading, and the one broker defaulted. And very smart chartered accountants, smart families gave them 20 crores anugrah. And that, 2-3 brokers were doing, I'm sure you must have heard. Now they gave 20% plus return. And I'm telling you, smart chartered accountants, smart families gave them 10 crore because he promised 20% return. Now, whenever there's a promise of beyond extra return, you should assume that there's something wrong, unless you understand that game. So that's the only thing I would say.
Okay. So Aditya, I would like to have your views on if there is a low yield regime, then how investment should happen.
I think so. Firstly, all of us should bear in mind that the world order has changed. So, one thing is that, there was an old adage on Wall Street that basically buy bonds and wear diamonds. That bond bull market lasted for like 40 years from the year I was born, 1981, essentially. And it was a one-way street, and nobody expected that 16% interest rate is going to be, possibly closer to negative. That had a very profound impact on psyche of people, I think so, because people thought that it is a one-way street. That also led to emergence of a very interesting product, which is 60-40, bond equity allocation, and that is what has happened in India as well, wherein the rise of balanced advantage funds, balanced funds as a category has been a very successful product. Fortunately for us, we were having elevated rates. So one of the beliefs that I have is that, if you are super bullish on India and prospects on India, the cost of capital has to fall in this country. What it also means is that, some bit of thought needs to be, given, if people especially are aging or they are retirees, because essentially, historically, people were very, very happy with 7-9% fixed deposit rates, basically no risk being taken by people, possibly, and park money in bank fixed deposits. And obviously that is where mutual funds have stepped in, especially on the debt side, wherein they possibly provide, 2-3% extra return. And now we have taken a very obscure route, because people are also, we are living in an age wherein, the Templeton fiasco on the credit side created an opportunity for alternative managers to look at, high yield products. Basically, so that has been a very interesting area, but obviously, risks need to be understood. But my view is that, from a 5, 7, 10-year perspective, obviously equities do deserve a part in the portfolio. On other asset classes, I think so my views are similar to what Vikas also said, essentially that, gold, most of the gold returns were because of the dollar. Essentially, your best outcome on real estate is going to be matching inflation, basically. So one thing is for sure that, you cannot avoid equities. The only thing, it comes with a caveat that, we used to get equity cycles every 7-8 years, 1993, 2000, 2008 being examples. Now those cycles are getting shorter because there is too much of turbulence in the market. And one thing that we have to remember is that, the largest hedge funds in the world are central banks, basically, which is the Fed, Bank of Japan, Bank of England, Bank of Canada, ECB. Basically, they become very, very active. Corrections are shallower than they what used to be, because, essentially it used to typically Tezi and Mande in equity market used to coincide with the, business cycle. No longer so, it coincides with the balance sheet expansion or contraction. So we need to be mindful about that. So one can tweak, equity allocation over a period of time, but whether there is a choice of being under allocated to equity, I don't think so there is a choice, especially from a 3, 5, 10-year perspective. I think so the decade is going to be golden as far as equities are concerned. obviously, this could be a mean reversion decade. Basically, wherein emerging markets can do well versus developed markets. Typically, start of a decade starts with a theme. Last decade belonged to developed markets. I'm a big believer that this is a mean reversion decade for emerging markets. So that's it.
Kushal, I would like to have your view also on some other alternative investments.
Okay. See, I would be very clear in one adage that I have grown up with is that in the long run, we are all dead. And where equity markets are concerned, see, the people who have mentored me have put ingrained in my mind that if in the stock market or in a particular stock, if I cannot make 5 times in 3 years, it's not worth it. All right. I have always had most of the allocation in the commodity market. Whenever I say anything, it is obviously globalized. I'm never India specific. And commodity markets by themselves beat all other markets hollow 10:1. All right. Now, the cycles in commodities are very different. So where the agricultural commodities are concerned, the cycles are maximum 15 months. And when you are looking at various production patterns, consumption patterns, surplus and deficits happening in different countries due to various reasons, it could be policies, it could be war, it could be geopolitical situations, or it could be just the weather-related exigencies. If they are predicted well, and even if they are not predicted in advance, you have enough time to enter and exit. And most of these commodities, when they make their move, they actually make it double or triple within 15 months. And when they have to fall, they're halving themselves because other countries have either brought in substitutes or the country itself producing it has substituted it, or the consumption patterns have changed because of they becoming a bit expensive. Now, due to which money can be made on both sides of it. And we also need to remember that the biggest of the big institutions in the world, all the major hedge funds and everything, they make their maximum cream out of commodities. Then it moves into the equity part of it. Where I am also concerned, I am also doing the same thing. You pick up any commodity, it first makes its move. There is always a time lag after which the individual stocks make their move. And again, the commodity reverses itself because of whatever patterns have changed. You can sell the futures of those commodities, make money, exit the stock, and you have them. You are actually right. Even getting the bottoms and tops of particular stocks if the commodity has been analyzed properly. I can give various examples of it in case if we have time and the questions are put accordingly. So for me, the commodity markets is very, very critical. I have always, wherever in the world I have spoken, I have always said, study that. You may be able to study the equity market cycles also precisely. Now coming to India specific, all right. There is one thing which I have marked since the time I have started my career, that whenever the Kharif and the Rabi season are good for India, the equity markets outperform because the maximum expenses are coming in from the rural India. As the farmers become rich, new houses, old houses are painted, capital goods are purchased, money is spent on marriages, gold, silver is just gulped down across the country. Right. And due to which even those cycles, from even the Kharif and the Rabi cycles, we can predict the commodities and eventually automatically the equity markets also bottom out. So I always believe that forget the low yield. Actually, it is just a theoretical concept. Even if I go out in the public to take money and I say you will have a principal protect product and I will give you an 8% return, nobody's going to give me money, and all principal protect products across the world have failed, unfortunately. Because everybody looks at the other person. If that other person is earning 20%, 30%, why am I not earning that part of it? So it is basically, even if I compare growth versus value stocks, forget that the time of defensive stocks has already gone off. All right. Now the comparison is only between growth versus value. And at that particular point of time, if I'm sticking to the equity markets, I would still prefer growth stocks, because yet there is a lot of appreciation left in a few of them. But still my number one spot will still remain as the commodity markets, because by themselves, they have the pure vanilla fundamentals. I don't have to look at questionable management. I don't have to look at window dressing, because I know whether it is an agricultural commodity, a crop grain, or a metal, I know exactly this is the production. This is how is the pattern of consumption. This is how the logistical movement is happening across the world. And hence, it is going to move from point A to point B, and I need to make money within those 2 points. And that will always result in very high returns compared to all other asset classes, except one, which is the newborn asset class of the digital assets. Now, the fundamentals work in a very different manner in that. And because it has not reached a matured stage, the volatility is too high. But a person who can understand the right fundamentals of the digital assets will be able to again beat the stock markets. I'm not sure about the commodity markets, because commodity markets are going to be very, very volatile, and the movements are going to be irrationally high and low on both sides.
So basically, I will say that if you are really good knowledge, really good knowledge, then delve with commodities.
Of course.
Otherwise, equity is the place where you should be.
So for me, I would always say equity is a much passive investment.
You must have the knowledge.
No. True. I stand correct. So, but now, since you had talked about risk element and other things, so I think I will put a question to you, that there is a new set of investors coming every now and then into the market. And many have that idea that higher the risk, higher the return. So whether that philosophy will work in equity markets, or there should be something more than higher the risk, higher the investment. Higher the investment, higher, sorry.
I got it. No. So see, again, this concept is a very relative concept. All right. And where the new set of investors, which you are mentioning, I would rather say it is the same set of investors, but moving from one asset class to another. All right. See, there are various examples in the current 2 years of bull run, which we are seeing, but I'm trying to take a little bit back in time. You know, after we came out of the 2008 crisis, which was there across the world, created by the Lehman Brothers and the Bear Stearns and everything, there was a 4-year phase where crude oil prices had shot up like anything. It was touching $140 a barrel. All right. And everywhere the concept was that we need to open oil wells across the board, and shale oil wells, the natural gas, everything started opening up. There was one particular commodity which every explorer required, and that commodity was only produced in India. There are other countries producing it, but at that particular point of time, 82% was produced only in India, which is basically the cluster beans, the guar gum. All right. Now what happened is, for every fracking, you require a huge tonnage of guar gum for opening up of every oil well. All right. And believe it or not, Halliburton's deputy directors were in Jodhpur, that even if guar gum was as a husk form on the floor of the warehouse, please sweep that, we require that. The prices of guar gum had shot up 22 times, and yet it was being sold, people were buying. All right. That was exactly the point of time where one particular commodity had an exportable surplus, an agricultural commodity which does not even produce more than 700,000 tons, 42,000 crores was the exportable surplus. Now, from the farmers to the packers to the exporters had minted money in 2011 and 12 over a period of 6 months' time. Now, in 2012, very precisely, Nifty bottomed out. All right. The money that was flown in into the equity market came in everything from Rajasthan. All right. In fact, the day why I remember this particularly is I'm not naming, but 3 of the top 5 eminent fund managers from Bombay, we were sitting at St. Regis and we were just discussing the collapse of the market and everything. I have been a commodities trader. I knew exactly what was going on. I was part of the Guar complex at that particular point of time. And I knew that these are the people who now want a less risky asset class. And for them, equity had become a less risky asset class. They were ramping up all the blue chip stocks and your stock market bottomed out. One of the fund managers had mentioned to me, I really don't know where the money is coming from because I sitting from an FII, I am not buying anything. My colleagues and my other competitors are not buying anything. The public sector banks are not involved in it. And the market has given a huge run up. After that, all the funds started because they had that the market has bottomed out. The dark clouds are over. Now, this is the strength of a commodity. Now, every 2-3 years, there is always one commodity which shoots up. There is one commodity which completely collapses. And whenever the people are on the right side of the commodity market, they immediately move to the equity market because for us, I will obviously say that because I am a commodity guy with the forte in it, will obviously prefer the extra money which I have made, let me move to a less riskier asset class. And for me, automatically, it becomes the stock market because then I'm again picking up the stocks based on my forecast of certain commodities that these stocks should outperform the market.
So any views on the high risk and high return?
Thankfully, somebody finds equity less risky. So no, anyway, my view on risk is very different. I don't think high risk means necessarily high return. Actually, at some level, while you can somewhere depends on what is risk. To me, there are 2 kinds of risk. One is the risk of loss of capital, and second is the risk of mark-to-market volatility risk. In typical conventional sense, volatility risk is more defined as a risk. Whereas I think I pay as an investor more attention to the capital loss risk. Ki mera paisa tutna nahi chahiye, So that is a big risk. So if let's say I buy something at 100 rupees and over next 1 month, it has gone to 110, 99, I don't get bothered. As long as I know that this 100 can become 300, right? Provided I know, it can. So risk is how very often people get very worried about the volatility risk. If you are long-term investor, that's a risk you should not pay much attention at all. And I mean, we as a firm, when we run money, in fact, we feel that our returns are the best in the assets where we've taken the least risk.
Okay.
But then you have to have a very different perspective of the returns, of the risk and understanding of the asset class. When he takes the risk on commodity, when he buys and when he knows that, it's going to be, then in his mind, the risk is very low, but somebody who's seeing from outside, somebody who doesn't understand commodity will say something is happening, right? So according to me, the biggest risk is actually lack of knowledge. That is, and I'm telling you with a lot of sincerity, most people lose money only because of that. They will put money by looking at somebody else, or, it's like if I give this example, in Nifty 20 years ago was 800-900 points. In last 20 years, UPA 1, UPA 2, global financial crisis, 3G scam, coal scam, Brexit, Fragile 5, all GST demonetization, GST implementation, IBC, pandemic, Ukraine war, you name the potential man-made crisis, natural crisis, once in 100 years of crisis, all kind of crises have happened.
Correct.
I have seen in this period my portfolio going down 30% also. But you don't lose patience, because you understand that this is all, as long as you understand, you don't get worried. And hence, so if 18-90% CAGR over a 20 years period is very big number, if 20x kind of return, right? So risk is how you see it, right? So if your horizon is long, again, depends on your, so one thing, the biggest risk is taking risk which you don't understand. If my age profile is 60 and I need money to sustain my livelihood, I should not put money into liquidity. But if I'm young and I have enough saving, which does not, so risk profile for each individual is different, and accordingly, he should invest into asset classes. People think credit is not risky, right? This year, last year, UK government's 100-year bond was down 80%. Now, what risk is 80%? Why? Because they invested at negative interest rates, and the interest rates have gone up. It's a 100-year time frame. Now, who in their right mind invested into 100-year-old paper at a negative interest rate? But somebody did. Now, who says that government paper are not risky? Even government paper are risky. Yeah. Right. So risk is, again, one has to understand risk, and I can tell you, to understand risk, you don't need a rocket science. I mean, it's not a rocket. You can commonsensically, understand risk with a very, very, simple, right? Whenever there is a, temptation of that I can make 20% return versus, normally if you think it's a 10% return, then you should assume that there is something which is more than me. If you understand that, like he says, I understand commodity, I can make 20%, great. Correct. But if you don't understand, don't follow into a trap of, so risk is it's most important part. Correct. And when we say investing is for two reasons, returns and risk. Risk comes first. And we say that if you don't do stupid things, your portfolio will do well. So you don't have to be smart to make money, actually. So
it has to be an informed risk.
It has to be informed risk. It has to be calculated risk. It has to be, knowledgeable risk. Correct. That, and I keep on saying again and again, because I think most people lose money only because of this.
So now, Aditya, I would come to you on some other aspect, because you are managing funds. So many a times what happens that normally it is, you have to be a disciplinarian when you are looking at the funds of the other people in a fiduciary capacity. But there is also, when the markets are exuberant and there are expectations of very high returns by the investors, then what will be the approach to convince the investors of what type of returns they should expect? And in the current scenario of India moving in a higher trajectory, what are the products that one should look at?
So I think so. Returns are important basically, but how we have been trained to think over. And this is, first of all, investing is very temperamental. It doesn't come to you naturally till the time you have paid a price to it. The approach that, I personally took in 2004, I started to, sort of join the PMS industry. 2006, I started to manage money. 2008, PMS ticket size was 5 lakh rupees. And that was the first experience of me as a manager, wherein literally I used to get calls from investors, basically, because if you sign up for a PMS, you have a right to speak to a manager. That is what is perceived, right? You are supposed to be treated as a HNI. People used to tell me that, 50% decline, you claim yourself to be an expert. How did this happen, basically, right? This is my hard-earned money. So this is fiduciary capacity for you. And obviously you go through, sleepless nights. By 2014, when I joined ICICI Pro, we had a phenomenal run in small caps, 2014 to 18, 37% CAGR. And what we decided to do was to shut down the fund and give money back to clients, basically. So what I say is that, return on capital and return of capital both matter. So this is point number one. How to navigate. Now, people can take, different approaches. Typically, India has been a very good long-only market, people have. So I think so. The real answer lies in horizon that people look at. Horizons are very different for different people. Obviously, investing is not a business of instant gratification. If people are looking for instant gratification, if people expect that, buy a stock tomorrow, I mean to say it should go up by 30, 40, 50% in a 1 year time, you end up, unfortunately, making a lot of mistakes. So discipline matters a lot. You have to step back and think, because typically what happens is that, and what I've also experienced in my investing journey is that you are always lonely at the top. You are always lonely at the bottom in this journey, because ultimately it is not a business of consensus, basically, right? And you get consensus at the top. You get consensus at the bottom. So the way we think about it is that, the best time to put your money to work is when business is not doing well, markets are not doing well. The problem at that point in time is that, people have seen a there is loss aversion, right? Because you have seen your portfolios going down by 30, 40, 50%. Temperamentally, right time, right place, only country like India, that is the only answer that I have. If we start to, use our intellectual brains basically and start to, question ourselves and find answers to questions, we don't get answers to questions, it is just a dark tunnel at that point in time. So I think so over a cycle, one has to think about the expectations that you set yourself. The goal setting is very, very important as an investor. So let's say if somebody is walking in with the expectation of 15, 20% return somewhere in the range of, and it obviously will commensurate with risk. What is the product that you are choosing? If it is small caps, obviously a little bit of high return. As Vikas mentioned, in India, fortunately, now we have a 20-year history of, just give you an example of small cap index, right? Over a 20-year period, it is 19%. A small cap mutual fund would have delivered 22% CAGR return, right? And it has happened over a 20-year period, Thankfully for us, Russell has a 100-year history, basically, right? In terms of looking at returns. So as long as your goals are met, you shouldn't be swayed by what the other person is making, you shouldn't change your goals, basically, right? You start your journey with the objective, basically, and discipline, that is how discipline comes into play. So I think so it is very important that when that cycle of greed comes through, basically step back and think about it, possibly some reallocation. And this is where the wealth management industry model of, moving or thinking in terms of bands, not necessarily taking a knee-jerk reaction on a particular day that, you have to be out of the market or something like that. I'm not saying that, you should do that. But at times you might tweak your approach, basically. Similarly, if you have a goal set for yourself and if markets are not doing well, especially after periods of, underperformance, and this is what we saw very recently from March of 2021 to 23, there was a period wherein a lot of companies got hit very, very hard by inflation, right? Something unusual happened, right? Because nobody would have experienced 10% rates inflation in the West, right? And this is what we went through. That created a wonderful opportunity because a lot of mutual funds and a lot of funds underperformed fixed deposit returns for 2 years running, right? I think so it was a good time to, allocate money to equities. Fortunately, after, I think so the way wealth management industry and the mutual funds have educated people is that, you should focus on asset allocation. And obviously, in a country like India, if you have a horizon of 3 years and beyond, I think so we are just fine, and think long term.
Because your view on this, if the market is exuberant and the expectations are very high by the investors, what will be your advice and the approach towards the investors who are investing in the funds which are managed by you?
See, the surest path to happiness is keep expectations low. So I think the problem is expectations.
But always there is a FOMO factor.
That's the problem. Now, I think most people, there's a bias called recency bias. In the investing is all about actually less technical finance knowledge, more behavioral. Investing success depends on that. And there's something called recency bias, which basically says that our human mind believes what has happened recently will keep on happening. So when the markets fall, people get scared because they think markets will fall more. And when markets, and hence they sell. And when markets rise, then they think markets will continue to rise, and hence, and as more and more people reach to that, then cycles get created, right? So that's a typical cycles in the market, which basically oscillates between greed and fear. So again, I would say that when you invest out of FOMO, that's the worst place to start with. You don't invest out of FOMO. Anybody, when this in last 2 years ago, this whole fad of new age was going on, and I used to keep on saying that, in last 4 years, all this thing happened. In our investing journey, we never invested into a single new tech fancy stock. And we kept on saying that let them go as they go. We don't believe in that. We did not invest. And a lot of people, see what happens is that people start dabbling small when they see here. As more and more people make money, they increase their capital commitment more because they think this is the... So at the worst time, you have the highest capital allocation. And that's the worst mistake. So, So never invest out of FOMO. Invest because you understand. Again, I'm going back to the knowledge. Or invest because you think that, yeah, equity would invest over 20 years. So I will invest in 20 years, and in a basic, simple investing, if you know how to invest, like smart investing in commodity or news tech, please do that. But then you have to know that, and you have to know how to get out of that. So very often in investing, mistake is most people are chartered accountant. You invest, you 18 hours, 16 hours, 14 hours in practice, right? And you make so much money. But, we want to spend 20 minutes in investing or 30 minutes in investing and want to make much more than that. And that happens to a typical salaried class. That happens to every businessman, right? So that's a very classic mistake. And when we say this sounds like a old boring auntie or uncle who's lecturing on the, but that's the reality, right? That's how you mentioned once a comment you made that, why markets when cycle comes. And this I also now started understanding, because now I have a little bit of age and years of experience. But every cycle, new investors come, inexperienced investors come, and they think that hum jeet lenge dunya and we know the stuff, right? The amount of money people have made and lost post-COVID, especially youngsters, is not funny. There is SEBI data, by the way, not my data, SEBI and NSE data, that in derivatives, 99% people make losses. Now, can you see 99% versus 1%? Somebody is making money, right? Somebody is making money, right? So my point is that I again say that there is a return in every asset class to be made. There's return in every business to be made, right? Provided you understand it, do it. So don't take risk which you don't understand. And I invest with the saying that, keep low expectation and invest right. You will be, like we launched a fund. I'm giving an example. We were super convinced on manufacturing as a theme in August 2020.
Okay.
6 months after pandemic. We believe that this is a very 10-year big opportunity. That time, even people in manufacturing told us that you are wrong. That kind of, view was there. And when our investors asked us, what kind of return you think you'll make? I said 18 to 20%. He said, what kind of return do you think markets will make? I said 18 to 20%. So he said, then why should we do that? I said, keep expectation low.
Correct.
If I deliver more, you'll be happy, right? That fund has delivered 45% CAGR return over last 3 years. Now, does not mean that now I can't say that because it delivered 45% CAGR, will deliver next 3 years 45%. Problem people make it, they look at 45% and invest into that and then have a disappointed. That's when I was saying expectation have to be, understood how you are getting it. So never invest out of looking somebody else, FOMO, or, looking at history. Invest only after you understand.
So basic message is that keep your expectations low.
Absolutely.
So that the investments will be fruitful. It will be looked at as a fruitful investment for the
That
investors.
advice I always give it to young professionals for the career also.
Correct.
For anything, because that's the key to happiness. If you keep expectation low, acha hoga to ho hi raha hai na.
Yeah, Kushal.
Even if we are halfway through the Zenism of having low expectations, the problem would be that 80% of all the funds will die out, because then people will not come to invest in the funds. All right. So the question remains is
Expectations.
People should not come with high expectation. People should come with reasonable expectation.
the reason is, okay, so there is one thing which I need to clarify here, which will supplement your point only. All right. The SEBI data, which Vikas ji has mentioned, is even I took it up, but usually, as my analytical mind goes, I always have to autopsize every data that I receive. All right. And as soon as I autopsized it, all right, SEBI has only made a very, very general statement. All right. The thing is that when you go deep into it, 60% of the people who had lost money on the derivatives were the ones who had hedged it against their portfolio. So eventually, they have not lost the money. Why SEBI comes out with this kind of data? Why discourage the people on the derivatives market? I still don't know. Because I'll tell you one thing. Before SEBI came to regulate the commodity markets, there was Forward Market Commission, which was regulating the commodity markets. And they had a very, very weird system because I, being director in one of the leading commodity associations, I used to be called many times by the regulator, and they would ask one question: we want data, who's hedging and who's speculating? I said, why are you concerned with that? What difference does it make? Even if you give a data that these are the people, because a hedger can become a speculator by double taking positions double than what he has on his inventory level, or I can go reverse also and take a position. So usually the economists who are sitting there, sometimes they do not understand what data is important and how it has to be portrayed. Till they don't do that, again, what Vikas ji is saying, the knowledge, not only from our side, but from their side is also lacking.
So, but I think they are trying to caution the investors that beware about derivatives. Maybe that's the message they want to give.
I mean, and again, you do the survey or forget that data, that is one part, but you check in general, people lose. I mean, generally people are, speculating and people who don't know. So you will find that even, anecdotally experiences. So I don't know, I have not looked at the data as much, but I'm assuming SEBI has done. Now, I don't know how much is this, hedging, how much is, we don't know that data. So
That is exactly
but
what
individuals don't do hedging. Individuals
don't do
but
hedging.
in their individuals as a segment, they are defined separately.
The sample survey was too small.
Okay. So Vikas ji, another question will be on when we look at other avenues, can you throw some light on the other avenues which are upcoming, like InvITs, REITs, AIFs, how the investors should evaluate them and make investments in those products?
So as economy evolves, newer and newer avenues come, like you rightly said, that InvITs and REITs are very, very good alternatives, which are coming up. REITs, I mean, generally speaking, in commercial real estate, we buy office, put it on the rent and earn income, right? That is generally speaking 7 to 8% kind of rental yield, which is going on for anybody, right? And if somebody is offering you that on a REIT platform, a larger portfolio, like I think Brookfield REIT is trading, is available in the market. That's the largest one. Now the returns are about 8.5%. And in what happens is every 5 years, 3 years, you have 15% escalation, right? Or every year 5% escalation in the rent. So your returns would be, and as 3 years passes by, your value of the cap rate will go up. So your returns would be between combination of yield and appreciation will be 7 or 8 plus 5. So basically in REITs you can generate between 12 to 14% kind of return, which is a very good return. So these are the opportunities here people don't look at, because again people don't understand this. So what is the underlying thing? Same thing is in case of InvITs. InvITs are basically, again, portfolio of assets they own. So let us say there's an InvIT from Reliance, or there's an InvIT from Power Grid, where they own the tower assets, transmission tower assets, which are supplying power through the country. And for that, they charge a rent, where that rent goes to the unit holders of the. So the trust owns those assets, and whatever income comes from those assets goes to the unit holders. Now that yield is anywhere between, again, depending on it, when it got listed, it was very high. As the prices have gone up, and so yield now I think is about 8-9%. But again, they are long life asset. Like where would you get when we put FD, or when we put, you have 5-year, like the InvIT, Power Grid InvIT is 35-year product. So for 35 years you can get 8-9% yield, which is, and plus growing, little bit growing. REITs can the same thing. You can get lifetime asset with growing yield. So these are very interesting alternative product, especially sitting in between classic fixed income and equity. So they are a combination of, in between. And then there are other asset classes which are developing, which I would say are more for a little bit qualified investors who understand, like, stressed assets. Like after IBC, a lot of companies are changing hands when they are in distress. So, there are funds who buy those companies at a distress value and put more money and turn them around. Those funds so far have been giving 18 to 24% kind of return, pretty much like equity. But again, one has to be careful whom you give, what kind of people who are running that. But that's an interesting asset. So structured finance and stress, these are the good, alternatives to evaluate. So fixed income ke andar, I think more and more interesting opportunities will come, because as the economy grows, what they call heterogeneity of the product, because need of the capital also goes up. Different kind of need of the, starts arising. There's another within fixed income venture debt, though I find it very risky that you are giving debt to the venture capital companies. So, but there are companies who are doing very well. I must say that they have their own way of understanding the risk. I don't understand, hence I don't invest. But they've been delivering well. So I would say so. Within that, there are very interesting opportunities, coming about.
Aditya, your view on two other aspects of two other products like ETFs and SGBs?
I think so. ETFs is a very simple phenomena, but I'm not a huge fan of, passive investing because, we have just gone through a wave of passive investing globally. I think so. One thing which is there in this business, obviously, is that, size is an enemy of returns. And this is what we have seen. I think so. India has not reached there generally, and it is a well-proven fact that in a market like India, obviously passive will grow, over a period of time, but active has a long way to, sort of grow. I think so. Next 10 years, possibly we shouldn't be worried too much about, passive investing. The only thing there is that, large cap has become a very, very competitive space. So we were just looking at, the way regulator is, sort of approaching the space. If you look at India, the definition of large cap is top 100 stocks, basically. And what we recently found was that out of top 200 stocks, and 101 to 250 is a mid cap in India, and rest entire 3,600 companies which are actively traded, everything is a small cap. But for those 250 stocks, what we found out was that 83% of the mutual fund assets are possibly parked, and which is like a very large asset base, right? It is approaching now 30 lakh crores of equity is invested into top 200 stocks or top 250 stocks, essentially, right? So my view is that large cap investing can be done through a passive route, but in terms of small and mid cap, small cap particularly is going to be a very, very large space in India. Obviously, there are people who are very, very focused in that space. Mid cap again is a very narrow basket now, which is 150 odd stocks. Small cap obviously is not. People think that it is risky, but I have a different view there. Possibly it is not as risky because in India, being a very large economy, the definition of a small cap is possibly a $8 billion company is also qualified as a small cap, which is not a small cap even possibly from a US standpoint. So that is passive versus active. SGBs could be an interesting opportunity. I think so. From a paper gold perspective, obviously, gold bonds are also an interesting opportunity to look at from a diversification standpoint. But I would say that people who don't understand anything about the market, want to keep their costs low, obviously can opt for, passive funds. But there is a long way to go in terms of alpha generation opportunity.
Thank you. I would like to conclude with one common question later on. But before that, I would like to have questions from the participants, if any, to any of the panelists.
I'll ask a question to Vikas first. As you are aware, PM Modi has said that 2047 is the year when we want to become a developed economy. So what are the steps that India should do right in evolving as a developed economy, and how India should actually focus and how the world should focus as far as India is concerned? And considering obviously India has to go abroad, the Indian industry has to go abroad, investment has to be both ways, abroad as well as in India. So what steps should India be taking to reach a level of 2047 as a developed economy?
So actually, if you ask me, we have a visionary prime minister. I'm telling you again, this is no political statement, but in generally, I'm saying from a, what they have done are the steps which are required to be taken. In the sense, what they have done is they have taken one by one all the deep-rooted problem, whether it US has been trying to invest one law across the country for 40 years, and they're still not able to do it. So we underestimate what kind of power, miraculous it was that to pull up GST, RERA, IBC, our tech stack. I am telling you, today we don't realize what has been done. It is best in the world, and people are learning from us. So all last 40, 50 years, what we went and took solutions from abroad and implemented here, whether they suit us or not. Today, India is building solutions, what needed for India, suiting Indian culture. Today, e-commerce, I mean, this one, UPIs, we all know that what has happened, right? How it has changed the game. Now in US, what is the big problem today? 2 or 3 big companies are controlling entire e-commerce, right? In India, they are going very differently, and they're making laws to curb and all, and lobbying happens and all. In India, now we are going through very different. ONDC is going to disrupt everything. It's another UPI moment. So what good part is that I think first thing what has changed, you need to do to that is change your mindset. So good part is that India does not have a constrained mindset. Earlier, what we used to say, we are a poor country, we don't have funds. You don't hear that from government. Government, no, I mean, Gadkari says, I don't have shortage of fund. So constrained mindset has gone away, meaning you can do anything. They are saying we are not constrained. Our constraint is to get things done, right? So if you see, a lot of deep-rooted reforms are going. I mean, what we have achieved, whether it is Chandrayaan to anything, a lot of countries are now implementing, and I am telling you today with a lot of responsibility, we will be implementing Aadhaar to UPI to in many countries. We will be knowledge partners. So I think first thing important is to create their own pride, right? Our own confidence had got broken in every field. Today, I mean, the way Indians are seen, Indians are received, is very different, right? So that itself is a very big, and then you have to also, to be a developed nation also, and to be a leader, you have to have military power is biggest essence. I mean, you cannot be gunda hona zaruri hai. In the sense, whether you go and attack or not, but you have to have capability. Because people have to be, these are capable people. So now, unprecedented investment is happening in building our defense and military strength. Does not mean that you will go and attack, but you have to have that counter thing, right? So I think if you see today, they are doing everything bit by bit, picking. Our laws were a big problem, right? Archaic laws we were, living with. Now you've seen what has happened, right? It is, I mean, I've been privy to how, Modi has a vision of 25 years, what they want to do. But the thing is, they can't do everything at a go, right? You have to also take, in a political, you have to win election also. And so to do public good, you have to be in the power also, right? So they are good part is that at least they know how to remain in power. Because otherwise, what Vajpayee did he did not know how to remain in power. They lost everything, right? So if you ask me, they are picking up every small part of it. Our judicial system needs a reform, right? Which is a very big problem. Now, I think through this law thing, they will do it. Education system needs a reform. Now we have a new education policy. We had a shortage of medical colleges. Today, every district has a medical college. IITs, IIMs. So we are building soft capacity. We are building. So we have to understand. We don't sit. See, we only read news, negative news in the paper. How many of us know that there is a medical college in every district of the country now, or some wherever it's not is being built? There are, I am in Jammu and Kashmir. I don't think even probably people will know. So what I'm saying is that there are IITs in Jammu. So these are the capacity building is happening, right? So I think government has a vision which they are executing. Now, of course, everything will not be perfect. Everything will not be. I mean, what happened in, mark my words, UP is the next Gujarat. The amount of work which is happening in UP is unprecedented. I mean, first is they fixed law and order, but now economic development there is huge. But in the same UP, in East UP, it used to be called dark part. You didn't have access. They didn't have access to anything. So what I'm saying, they're connecting people. They're building Northeast. So they're building all-round development across the country. And once people have aspirations are ignited, like I like to give this example. I come from a very small village in Rajasthan, 5,000 people population, right? I went there, and I'm sure most of you don't know this. So they have this something called E-Mitra, E-Kendra. It's a, PCO kind of shop. So I went there, I swiped my finger, and I withdrew money from my ICICI bank account by swiping my finger. Now think about it. Now that shop, it acts and this is not ICICI, there's no ICICI bank branch, no ICICI, any bank account holder can do that. They are doing all Aadhaar card, PAN, WAN, suppose all. So all government services are being delivered to the last mile of the village. Now think about it. Those people have account. They can transact. their credit history is getting built. Their account banking history is getting built. They can become lendable. All banks will lend them. Now, what impact that person who is to borrow otherwise at 30% from the Saukar can borrow from a bank's automatic through a, without even meeting the person, through a automatic borrowing channel. You and I cannot imagine the difference which made to that person in that village, small village.
Yeah.
Now, delivering that at the low cost, you can imagine. So what I'm saying is that a lot can be done, but I'm telling you, they have a plan. I am fully convinced that, what they are saying, they are not, and the execution is a master. I mean, I am privy to some of the, I remember 2015, I met an undersecretary when they were doing Jandan account opening. He used to tell me, Modi ji calls me every day, aaj kitne khule? That's the kind of pressure, there is on the system to execute. India needed execution machinery, focus, getting things done. Solutions sabko pata the. So I would say that, we are on a reasonably good path. All I'm just saying that our biggest risk, according to me, is a political risk. I mean, we don't know. It's an fortunate and unfortunate part is democracy, right? In democracy, we have had Lalu Prasad Yadav ruling for 30 years and ruining the state. In this very country, we have had multiple. So I think those risks will live, but hopefully this will self-correct.
Anybody else?
Just to supplement what you mentioned, the real big next thing is going to be UHI, Unified Health Interface, because there is something which will revolutionize the healthcare across India. Now, coming back to Kushal, maybe about 5 years on the same platform, you had mentioned that you see oil, crude, to be somewhere in the range of 65 to maximum 80. Now, what's your reading on that?
Okay, so all right, with the revolution of electric vehicles across the world and the pace at which it is growing, specifically in developed countries and even in a country in the less developed countries. In fact, even the Indian figures are very upbeat on that part of it. The incremental demand for crude is reducing. Whatever they may say, just now OPEC is controlling the supply to the demand. Before it used to be demand versus supply. Now it has gone reverse. In fact, a lot of industries like fertilizer and all, the use of naphtha has gone off and natural gas has come in. All right. There is a possibility that down 10 years, the speculation in crude oil itself will vanish. Only a geopolitical global warfare can result in crude prices going above $100 a barrel in an artificial manner. Because even the Russia-Ukraine war never resulted in that, because crude was available from other places. So according to me, the importance of crude will diminish unless there is some external factor. So we need to look at many other assets in that case of what is going to replace crude and try and make money out of that.
And how do you see just this development where in BRICS about 85% of the global crude product producers, I mean, they have joined together.
See, all the countries who have joined together, they don't get along well politically and culturally. All right. Even if I have got my own skepticism on it, that even if they talk about de-dollarization, not possible. All right. Because I would just pose a question. Would you like to invest in a communist currency of China? No. All right. Because you cannot accept that as a global earmark. So automatically, whatever is going to happen may happen between the countries and with their own currency terms. But they attacking the world currency system, not possible at all.
So before we conclude, I think I will have one last question for all the three of you for the benefit of our participants. Which are the sectors from equity perspective in India which one should look at from the next 5 years perspective? You can start, Kushal, then.
See, within the asset classes, when I just wanted to correct one particular point, all right? When people were talking about equity being a soft spot, I mean, it's the sweetest spot where India is concerned at number 2, number 3, number 4. And considering that India is on a rising horizon, see, I would prefer to be a global Indian in that case, all right? If a little bit of logical thinking is applied, electric vehicles are revolutionizing the world, even where India is concerned. The first thought that has to come to me, what do I require? All right. I require lithium. India does not have lithium as of now. Most of the lithium is coming in from the South American countries. Why not I go to some of the South American companies and make money out of it? So first of all, if lithium is in demand, I would look at lithium as a commodity. Lithium as a commodity has already increased 12 times in the last 5 years. I can make money in that. Secondly, if I have to look at it from the stock market perspective, I would look at it from a lithium miner. Who is the greatest lithium miner? Albemarle. Albemarle from $50 has moved to $250 in a span of 5 years. I would like to make money in that. All right. Thirdly, why not invest in the indice of that country? Because all indices are available either through ETFs or directly through futures and options. All right. Now, the greatest indice which has worked in, I would forget 5 years, I would say from last June 2022 to August 2023 is the Marvel Index of Argentina, because all the lithium was coming from there. 1,25,000 to 5,50,000 and still going up. In 1 year, I'm making 4.5 times. The ETFs of Argentina obviously cannot equate the same thing, but they are up 3 times. So for me, if I'm looking at from an investor's perspective, I would be looking at various places where I can maximize my returns. So if I say that 90% of the humans are bulls by nature, there is somewhere a bull market running always. And that bull market will be exuberantly irrational. And why not? Behti Ganga mein haath dho lete hai. All right.
Not have access to those things.
No, the question is not that. See, now what has happened is Reserve Bank of India guidelines, $250,000 per individual. You can invest abroad. Kotak Securities or many other brokerage houses are giving you the permission for that. So the question is, I know a lot of my friends who have started moving globally. So if I have to even allocate my asset classes, I would not say that I would put 80% in India. I would start looking at where the allocation should be the most, because that is a product of that country. The country is going to capitalize on that product, and that product may last for another 30 years. That country is going to grow for that particular product. And if maximum of the companies are listed in their own stock exchange, they have to have appreciated a lot. And this is what it is. My second sweet spot would be Vietnam. Vietnam has doubled its indices because of the agricultural crisis that is happening in East Europe and in Russia, Ukraine. Vietnam was able to completely sell off all its agricultural produce. The indice has gone up from 672 to 1172 in the matter of 6 months. Why not? So this is what I would put at. So in such a case, if only equities have to be looked at, let's look at the global equity structure.
Okay. So sum and substance is that not only India, but world should be the investable place. Vikas, your viewpoint from India perspective.
India in
at least.
general will do well, but I guess banking and financial services will do, very well. Manufacturing, I'm a very big bull. I think next 10 years, what probably happened in IT in mid-90s will happen in manufacturing. Very, very, big opportunity space. Same thing, information technology. Reason we spoke that there's a structural growth. And there will be, again, each of them will have its own cycles, but structurally speaking, they will then finally consumption oriented stories. But there you have to see what valuation you buy and stuff like that.
Yeah.
But generally, these 3-4 sectors which are well aligned towards India story will do well.
Okay. Aditya, your view?
Yeah, similar thoughts, but I would say that Sunrise Industries, because clearly one of the things that we have to recognize is that, and this is a government agenda, that most of the developed economies, if you look at the structure of those economies, if you look at Japan, if you look at South Korea, there are top 10 conglomerates that benefit the most. One of the themes that I like is the smallest investable company of a group that you admire, basically, could be an interesting case study to look at. It could be in a sunrise sector because, we have just gone through this wave of, a lot of startups getting now starved, basically, and a lot of conglomerates will move very fast, basically, because they clearly believe that they have missed on the startup funding phase, basically, wherein a lot of unicorns and $10 billion enterprises got listed in the markets. Obviously, there are a lot of sunrise sectors to look at. Obviously, there are areas where, you can apply a global case study of a sunrise sector to a country like India. It happens in e-commerce is a very interesting place. But the problem in India typically has been that a lot of American companies benefit out of India as a consumer market, and we don't benefit, from an investing perspective. That is true of WhatsApp, that is Facebook essentially, and Amazon, but there could be second derivative plays here, basically, right? The beauty about Indian markets is that there are, for example, a logistic company can benefit immensely out of the e-com boom in this country. So there could be, not so obvious areas to focus on. Apart from that, I think so consumption obviously is a very interesting sector. Where we are today, a lot of urban consumption plays have been hit very, very hard because mortgage rates moved from 6.5% to 9.2 within a very short span of time. It has hit a lot of brands, same store growth, basically. So that is a very interesting area. Within IT obviously is a very well discovered sector. Engineering, research, design is a theme that we like a lot. Apart from this, obviously there are going to be structural places to make money over a period of time. Healthcare is something that we like a lot. Typically a lot of companies who have gained market share in a down cycle, obviously up cycle will come and they will benefit. So these are some of the sectors that I would like to mention.
So thank you all the panelists for sparing your time and giving us valuable insights into equity and beyond other products to invest in, and also your foresight of how India is moving forward and what will be the opportunities in the Amrit Kaal. And without taking much of your time, I'll request Eshank to propose a very well-deserved vote of thanks.